The Fed easing cycle is underway. The Fed is dovish, and that's monetary liquidity. That should be good for risk assets. We also think the Fed wants CEO confidence to recover, which we would measure through the ISM moving back above 50, because that'll boost employment. The spread of mortgages to 10 years should fall, which should boost housing. And he's reducing the benefit of owning cash. It's getting less yield. And that's going to push cash off the sidelines, and that's risk on. So in a simple way, I think the three things to focus on would be Mag 7 and AI stocks, crypto, which is Bitcoin and Ethereum, and then interest rate sensitive groups like small caps and financials. But I would say, historically, the initial bigger effects tend to be monetary liquidity and the fact that cash is coming off the sidelines. Since the Fed announced its cuts, the leadership has come from crypto, Ethereum, and Bitcoin. That's very similar to what happened in 2024 when the Fed cut in September after an extended pause.
Today, as crypto investors continue to speculate if the bull run will commence in October, and if we can expect to see a price increase in Bitcoin and Ethereum in the coming weeks, this crypto cycle is heating up. And Tom Lee remains bullish, with a parabolic rise in the last few months of 2025. Forced selling, leveraged bets, and the usual tug-of-war we see when an asset approaches such a huge barrier. The bigger picture looks very different, though. Analysts are drawing a striking parallel. Ethereum today may be in the same position Bitcoin was back in 2017, when it rocketed from $1,000 into the financial spotlight as Wall Street started paying serious attention. And just like Bitcoin back then, Ethereum is now catching the eyes of institutions, hedge funds, asset managers, and major investors who see its role extending far beyond speculation. Bitcoin has been trading more like a risk asset lately, meaning if the market recovers, Bitcoin is expected to surge alongside it. But the uncertainty is key here. If the market remains stuck in limbo, Bitcoin could face short-term pressure. Bitcoin's price currently sits just over $109,500, still down almost 3% in the past week. The community is buzzing, and adoption is spreading across industries from decentralized finance to stablecoins. Even the regulatory environment, often seen as a stumbling block, may be tilting in Ethereum's favor. That makes Ethereum more than just a digital currency. It positions the network as a backbone of future financial infrastructure. And as Tom Lee points out, this is likely just the beginning. With Wall Street's deeper involvement and retail energy still strong, Ethereum's growth story has room to run. The question now isn't if Ethereum will climb higher, but how fast it can write the next chapter in crypto history. Let's get right into the latest interview with Tom Lee, as he gives his market prediction for the days and weeks ahead.
I wanted to start this video by talking about the macro because the Fed easing cycle is underway. The Fed announced a 25 basis point cut on Wednesday, and it was dovish in my view because the Fed acknowledged not only is a future cuts coming, which is an easing cycle, but that he acknowledged that the inflationary pressures from tariffs was less than they were expecting. So again, more in the camp of transitory inflation. This is something that we had taken a view on over at Fundstrat, that we'd expected stocks to rally post-Fed. And we see that indeed there was good follow-through in both the NASDAQ and small caps, which outperformed the S&P. The NASDAQ up 1% in the 24 hours after the Fed announced this cut, and small caps up 2.5%. Now you might wonder, will stocks continue to gain? And the answer in our view is yes. I'm citing some stats from Ryan Detrick at Carson Group, and he points out that when the Fed cuts within 2% of all-time highs, the S&P is higher 20 of 20 times, with an average gain of around 14%. Now you're going to wonder, what will outperform post-Fed? We just want to give you a simple framework. The Fed is dovish, and that's monetary liquidity. That should be good for risk assets. We also think the Fed wants CEO confidence to recover, which we would measure through the ISM moving back above 50, because that'll boost employment. The spread of mortgages to 10 years should fall, which should boost housing. And he's reducing the benefit of owning cash. It's getting less yield. and that's going to push cash off the sidelines, and that's risk on. So in a simple way, I think the three things to focus on would be Mag 7 and AI stocks, crypto, which is Bitcoin and Ethereum, and then interest rate sensitive groups like small caps and financials. But I would say, historically, the initial bigger effects tend to be monetary liquidity and the fact that cash is coming off the sidelines. The leadership has come from crypto, Ethereum, and Bitcoin. That's very similar to what happened in 2024 when the Fed cut in September after an extended pause. The stocks that are most correlated to Bitcoin and Ethereum are MicroStrategy, ticker MSTR, which gained 6% on Thursday, and Ethereum, most leveraged stock, is Bitmine, which is the largest holder of Ethereum in the world, and that gained 5%. Many of you might think markets are in a bubble because the Fed's cutting near all-time highs, but as we pointed out, that's happened many times, and 20 of 20 times stocks still gained after that. But I think the way to think of it is to think about NVIDIA, which happens to be a granny shop. But as you can see, NVIDIA's PE is 26.6 times. Now, do I think that's expensive? I don't. First of all, as you can see on this chart, it's in the middle of its range over the last 5 years. But keep in mind, Costco and Walmart trade at 48 times and 34 times earnings. These are far less scarce and unique than NVIDIA. NVIDIA is the most scarce company in the world today because they make a chip that every AI company needs. So until NVIDIA trades at the same multiple as Costco, I think NVIDIA is not in a bubble. Well, in 1998, September 98, Cisco was at $16 and 55 times forward earnings. Why am I setting September 1998? Well, that's similar to 2025. The Fed was on an extended pause and then they cut in September. In the following 12 months, NVIDIA went to $80 per share and its PE went to 210 times. So its stock went up 5x and the PE went up 4x. Now that's what I call a bubble. We're not there yet with NVIDIA today at 26 times forward earnings. More importantly, look at sentiment. The AAII net bulls less bears is still negative. There's more bears than bulls at an all-time high. In fact, we've had 7 weeks now where markets have made an all-time high and yet sentiment is negative. You can't really say we're at a top if investors are bearish at the highs. So let's talk about granny stock performance. The top 5 performers of the past week are Oracle, Tesla, Vistra, Lam Research, and Palantir. Now they're all AI related, but Oracle, of course, surged on good earnings. And Tesla is gaining because Elon Musk made a pretty big insider buy of $1 billion. The worst 5 performers were Garmin, Amazon, Robinhood Markets, Cadence Design Systems, and Netflix. Some of this is profit-taking, especially a stock like Cadence. And in terms of themes, the best performing theme was energy and cybersecurity, led by Palantir and Vistra, and GE Vernova, and labor shortage, which is Oracle, Tesla, and Lam Research. Seasonality also worked. Again, Oracle was flagged as a seasonal trade, as was Palantir. But Palantir has been a granny shot for a long time, as well as Oracle.
Ethereum isn't just holding its ground, it's starting to pull ahead. As 2025 winds down, Ethereum has actually outperformed most other major crypto assets, driven by record on-chain activity, surging developer adoption, and growing institutional demand. While Bitcoin continues to anchor the market, Ethereum's momentum is signaling that it could be a real leader in this next phase, setting the stage for what analysts call its strongest run yet. Embracing an unyielding enthusiasm for the Bitcoin realm, Tom Lee confidently predicts that explosive growth is looming on the horizon, as BlackRock and many other crypto giants are doing just that. Tom Lee reassures that a long-expected surge awaits. By the end of 2025, there will be 1.1 billion active crypto wallets. The pace of growth is hard to comprehend, and it will be the fastest accumulation of wealth we have ever seen. This is the conclusion of a career's worth of research. And every single chart and piece of research leads to the same conclusion. Liquidity drives everything, and crypto will be the best performing asset of them all.
The ETFs, for example, which have already purchased about $20 billion of Bitcoin year to date. MicroStrategy, that's another close to $20 billion coming in. And then, of course, a host of these other digital asset treasury vehicles that are bringing fresh capital into the industry, purchasing spot crypto commodities like Bitcoin. And so, in my opinion, that's going to be coupled with just the macro environment, whether it's inflation, labor markets, et cetera, that kind of risk on sentiment is what I think is driving a lot of the price action. There isn't some kind of very crypto idiosyncratic factor that's really promoting like a huge run. And at the same time, I think because of that, we're not seeing any kind of systemic risks or points of concern that would cause me to think like we're entering bubble territory and that it's going to pop for some particular reason. So I think right now people are just pretty bullish. They're positioning themselves perhaps neutrally to positively long crypto, and that's what we're seeing play out.
And I want to focus on crypto ETFs because the SEC approved proposals from major exchanges to change its listing standards for exchange-traded products. SEC Commissioner Hester Peirce said that the new process would reduce the time and resources required to bring new ETPs to market. Explain what this rules change means for spot crypto ETFs like the XRP and Dogecoin funds that came to market today.
Yeah, so straightforwardly, all exchange-traded funds have to go through this kind of rulemaking process where they have to apply for permission because there is no like legislatively clear path for an exchange traded fund to come out to market the way that you might see like a normal company go through an IPO process. And so they all go through this kind of application process. And what we've seen through crypto really over the last decade was this long drawn out process of applying for the ETF. And I'm talking about the Bitcoin ETF here. You apply for the ETF, and then there's some rationale or reason that was given for the denial. And each time we went through this application process, we would see a different reason for that. And the industry was slowly curing all these difficulties and whatnot up until, of course, we had the Bitcoin ETFs launch early last year. And so what happened now with this new like ETF rule process, if you will, is just full clarity for the industry. That is, if you want to launch an exchange traded fund on these commodities, what are the requirements or prerequisites, whether it's an active futures trading market where contracts exist on CME, for example, for some of these commodities, and whether that basically gives permission for new vehicles to come out without this long drawn out kind of discovery process of guessing and checking whether these products can come to life.
So what do you think will change now for crypto ETFs, especially given there are still several applications pending with the SEC for ETFs tied to different altcoins, including Litecoin, for example?
I mean, I think having this kind of like standard approach to analyzing the ETFs or the applications that is going to allow them to come to market faster. And to the extent that there are new coins coming into it, it's not like you can just list any coin at this point. Some of these rules have different criteria in place. Like, for example, does an existing futures market exist traded on an exchange like the CME group? And so I think you're just going to have a host of different ETF products on known commodities where these conditions are already met, where they're not going to have this long drawn out process. They're going to come to market more quickly, and they're going to be vehicles for additional capital to move into some of these, altcoin effectively spot commodities. And so you're probably going to see like a natural bid in some of these, I think, through these new ETF products.
Where does all of this leave us? Ethereum has crossed $4,000, weathered short-term volatility, and is now attracting the kind of institutional attention that once catapulted Bitcoin into the mainstream. Analysts are increasingly framing this as Ethereum's 2017 Bitcoin moment, where the groundwork laid over the past decade finally meets global recognition and capital inflows. But here's what makes this cycle different. Ethereum isn't just competing as a digital currency, it's the infrastructure powering decentralized finance, stablecoins, and entire ecosystems of applications that regulators and institutions are beginning to take seriously. That combination of utility and adoption is exactly why many see $5,000 and beyond as not just a price target, but an inevitable milestone. Over the past year, Ethereum has quietly outperformed most other major crypto assets. Tom Lee and other top analysts emphasize this point. Ethereum's real growth story is still ahead of us. With Wall Street leaning in, developers innovating faster than ever, and adoption spreading across industries, Ethereum is positioned to be a defining force as we head into 2026. The bottom line: the short-term swings may grab headlines, but the long-term trajectory is unmistakable. Ethereum is evolving from a promising blockchain into a cornerstone of digital finance and technology, and if history is any guide, the breakout we're seeing now could be just the opening chapter of Ethereum's biggest run yet.